Good morning, trading family, and welcome back. Hope you had a good Memorial Day weekend. Stayed out of the charts, touched some grass. Markets are green this morning. Dow futures up 306. But the reason why they're green, that's the whole show today. Quick housekeeping. I'm sitting at $111,788 combined, 6 positions. Advanced Micro Devices, IMD, and Broadcom are working. Alphabet, Google, is still underwater. No new trades today.
Wave trader running 10 positions this morning. 8 signals fired overnight. Clear to trade if conditions hold.
US bombed southern Iran overnight. Oil dropped 3.4%. The market is green. That's not a misprint, and why the market is doing that is everything we're talking about today.
Quick reminder before we dig in, nothing we say here is financial advice. We're two guys talking markets. Do your own research, make your own calls.
So here's the paradox. The United States bombed southern Iran overnight. Trump is out there using nuclear dust language on camera. And Iran publicly denied that any deal even exists right now. Meanwhile, the ceasefire got extended 60 days. But the Strait of Hormuz is still closed, 3 months this week, and oil drops 3.4%. The market is pricing bombs as a deal-forcing mechanism. That is what we're calling peace trade logic.
There's a receipt that makes this stranger. Gold has been flat at $4,525 for 6 straight sessions. Oil broke hard. Gold didn't move at all.
That's the tell right there. If a real deal were actually coming, signed, done, sealed, gold would have moved. It always does, on genuine resolution signals. 6 flat sessions is gold saying, I don't believe it.
Bloomberg's MLIV desk turned bearish on this last week. Their line was that the artificial intelligence economy disconnect has to close, either positively if the grand deal gets done, or much more negatively if it doesn't.
And that gap is enormous right now. Iran is asking roughly $100 billion. The United States is offering $20 to $25 billion. Bloomberg reported a spread of $75 to $80 billion. That's not a rounding error. That's a different negotiation.
And here's the structural problem, even if the gap closes. 3 months of straight closure has already compounded into supply chains. The inflationary lag lingers whether or not a deal gets signed tomorrow.
It's baked in.
The whole logic chain. Deal leads to oil down leads to inflation down leads to rate cuts. That requires every single link to hold simultaneously. That is a lot of links to trust at once.
And the market is acting like every link is already golden. Oil is celebrating a ceasefire that Iran hasn't agreed to, over a gap that's $80 billion wide, for damage that's already done.
Oil and gold are telling different stories because they're measuring different things. Oil is reacting to deal probability. Gold is reacting to geopolitical uncertainty that doesn't disappear on a signature.
One quick aside before we move. Copper is worth keeping in the back of your head here. Some commodities right now are trading like artificial intelligence meme stocks. Structurally, strong long-term, overheated in the short term. Just color, not a trade.
The structural demand is real. The current pricing has gotten ahead of it.
So, that's the Iran paradox. Market green. Oil down. Deal not signed. Gold unmoved. The market is celebrating the opening of something that hasn't been struck. Now, let's talk about this morning's earnings. AutoZone, ticker AZO, is printing today. The estimate is $36.09. And here's what AutoZone actually is. It's the American consumer keeping their old car running because they can't afford a new one. That's the thesis, in one sentence. Michigan consumer sentiment came in at 44.8. That's near historic lows. If AutoZone misses, consumer cracking is confirmed. If they beat, the question is why? Did they beat because spending is strong? Or did they beat because they raised prices faster than customers noticed? Two very different stories. Same headline.
There's a reason those two things can coexist. The SPY at 745 and Michigan sentiment at 44.8 in the same week. The top 10% of earners in this country drive over 50% of United States consumer spending. SPY serves that America. AutoZone serves a different one.
The one that's cracking.
Exactly. This print is a direct read on the bottom 80% of this economy. The number this morning matters, but watch how the stock reacts, not just the headline.
If the stock gapped down on a miss, that's confirmation. If it gaps up on a beat, you still have to ask the second question. Strong demand, or just higher prices they couldn't say no to? All right. The Warsh yield curve trap. This one's all TB.
Bloomberg's headline this morning literally named this thesis: rate cuts up front, chaos out back. That's the setup. The IOM, small caps, ripped from $273 to $285 in 5 trading sessions. That's 4.4% in a week, all on rate cut hope. Small caps are the most rate-sensitive index in the market.
That move was real. I watched it happen in real time.
The problem is the 10-year yield is sitting at 4.56% and has not moved. Bond traders historically get macro right faster than equity traders. Bloomberg's analyst said that explicitly. The European Central Bank, ECB, is revising inflation upward this same month. This is not just a United States rate story. There is global pressure pushing directly against the rate cut thesis.
So equities are buying a dovish Warsh. Bonds are saying no.
And Thursday morning at 8:30 Eastern is when this resolves or breaks. Personal consumption expenditures, PCE, drops Thursday. That is Kevin Warsh's first data point as chair. If it comes in hot, above expectations, he has zero room to signal dovish at his first FOMC meeting in June. The trap springs on day one.
He walks in on his first day, and the data hands him a problem he can't dodge.
If PCE is hot, every equity trader who bought small caps on rate cut hope is staring at a head fake. 4.4% in 5 sessions can reverse fast.
The bigger the rate cut trade unwinds, the harder that IOM run gives it back. Thursday morning is the moment. Circle it. Tomorrow night is almost as important, because the artificial intelligence invoice comes due. Marvel Technology, ticker MRVL, reports after hours tomorrow. Salesforce, ticker CRM. Snowflake, ticker SNOW. Expected moves: Marvel 14 to 15%, Salesforce 10, Snowflake 14 to 15.
Marvel is the most important print of the 3. Not because they're the biggest, because of what they represent. This is the first pure-play custom silicon and hyperscaler artificial intelligence earnings report after the NVIDIA sell-off. No China export noise. No consumer graphics. Pure artificial intelligence capital expenditure demand signal.
If they beat, and the stock runs, rotation from NVIDIA into broader artificial intelligence infrastructure is confirmed.
If Marvel sells off on a beat that says the NVIDIA sell-off was the right read, artificial intelligence capital expenditure enthusiasm has a ceiling, and we found it.
The question isn't, did they beat the number? The question is, did artificial intelligence spending actually turn into artificial intelligence revenue? Picks and shovels only work if someone's still mining. Wednesday night is when we find out.
One more reframe on the Huawei angle, because the coverage keeps getting this wrong. The story gets written as sanctions backfired. I'd push back on that. Taiwan Semiconductor, TSMC, is manufacturing at 2 nanometers today. Huawei is targeting 1.4 nanometers by 2031. That's 5 years out. That's not a moat breach. That's a reason hyperscalers spend more on custom silicon right now. Every Huawei breakthrough headline justifies another $10 billion in capital expenditure on the other side. Marvel Wednesday is the vote on whether that thesis is still intact.
It's tempting, but a 14 to 15% expected move is a coin flip, not a trade. I'm keeping my powder dry on this one. Quick hit. Futu and Momu down 28% on China's $271 million penalty. CNBC put it perfectly. Tariffs eased. Trust didn't. Chinese executives came out and said the real barriers aren't tariffs anymore. Data security, branding, trust at the corporate level. Market got way ahead of itself on China relief. Tariff headlines aren't the whole story. One number, one punchline, we're moving on. All right, here's what we're watching for the rest of this week. And this is where it all comes together. Tonight, you've got nothing. But tomorrow night, Marvel, Salesforce, Snowflake after the bell. That's the artificial intelligence honesty tax. We find out if the infrastructure spending is real.
Then Thursday morning at 8:30 PCE. That's when the Warsh rate cut trade either holds or breaks. That's also when the IMED head fake either confirms or gets denied.
And AutoZone. We'll have that number before Thursday. That tells us about the consumer the market keeps ignoring.
On TLT, the long bond fund, if PCE comes in cool Thursday, that's a bond rally setup. But that's Thursday's trade, not today's. Not front-running the data.
My NVIDIA position. I entered at $213.20. I'm up about $20, and I've got 230 as my target. I'm letting it run.
The through line on today's show is the same thesis every segment. Iron. The market is pricing a deal that hasn't been struck. AutoZone. Pricing a consumer that may be cracking. Warsh. Pricing rate cuts the bond market doesn't believe in. Marvel. Pricing artificial intelligence revenue that hasn't been confirmed yet.
Well said. The market is celebrating the future it wants, not the present it has. That's peace trade logic. That's trading floor for Tuesday, May 27th. Thursday is when it all lands. Keep your thesis tight, and remember, the market will test your conviction before it rewards it.